All right, good afternoon, everyone. Futures Brizio here. Just after 4 p.m. on Tuesday, April 8th, 2025. Hope everybody's having a great day. And two things. One, apologize, I've been away for about a week. I had some family and friends visiting last week, so took a lot of the week off, and actually going to have the same thing at the end of this week. So I'll be around for the first few days this week, and then I'll be off again the rest of the week. So a little bit in and out, but that's why I've been absent. Other thing is, you can see I'm sporting a new webcam here. I've yet to figure out how to blur my background. Not that there's anything really in back of me here other than a painting on the wall and a couch. But I'm trying to figure out how to do that in OBS and have it actually look acceptable. So, but I do like the camera though. Shows my bald head really nice. Anyways, so let's just jump in. Forget about that. All right, so what we're going to talk about today is yet another way to potentially day trade and or scalp futures using one indicator. I have talked about this indicator, but it's been a long time. And so again, guys, I go back and forth making videos on using either longer term time frames like the 4 hour, 1 hour, 4 hour, kind of that top down analysis. And then sometimes I like to do ones like this where, for those of you that want to try to day trade or have the time for it. And remember, scalping or day trading is highly risky, and many times people fail at it, which is why the long-term charts are generally going to be better. And people that don't trade full-time don't have time to sit there, especially during the time when you have to day trade. If you live in like the eastern United States, well, that's kind of like prime time for people that have day jobs, right? Because you have to be in front of your charts from about 8 a.m. until about noontime, or at least for a couple hours. 8 a.m. to 10, 9 a.m. to 11, maybe up to about noon. Okay. And so that can be difficult for people, which is why swing trading or using higher time frames can be an advantage. Okay, sorry guys, I had to pause the video for a sec there. So not sure where I left off. So I go back and forth making videos that have where you might use a higher time frame versus using lower time frames, just depending on your schedule. So this one is kind of a unique way of using a volume-based indicator. That's not really traditional. Usually this type of indicator can be used like with divergence, which is perfectly fine for that, where you see the indicator going in one direction and price going in the other direction. That can indicate a divergence. So if price is going up and the indicator is going down, it could be that uptrend is running out of steam and could signal a potential reversal. That's not how I'm using this, but that is a way to do it. So it's called the on-balance volume indicator. So in MetaTrader, this is available on any platform, but in MetaTrader, it's right here under volumes. It's right here, OBV for short. I set it to real volume. You can use tick or real. It doesn't really make much difference, but it's slightly different, and you can obviously pick whatever color. For scale, just make sure none of these boxes are checked if you're in MetaTrader, because you want this thing stretched out as much as possible. So if scale by line could be defaulted, just make sure you uncheck this. You want this thing to be as open as possible. Okay? But this is in TradingView too. No, we don't need it on here twice. This is in TradingView too, so you can find it anywhere. So I'm not going to get into a big calculation of what OBV is. If you just Google on balance volume indicator OBV, you'll find plenty of websites that kind of detail how it's calculated. But again, it uses volume and price. So it's almost like an oscillator, but it is volume heavy. But like I said, I'm not going to get into a big definition about how it's calculated. If you want to know that, you can check it out. But essentially, it does follow price, so it will go down if price is trending down. It will go up if price is pointing up. which is not the same for all of these type of indicators. The other thing is, it's very similar to the accumulation distribution, which you actually can use that if you would like to. They're very similar. So again, it's under volume. It's called accumulation distribution, and it's pretty much the same. You set it for real volume, color. Make sure there's none of the boxes are checked. Again, this is in MetaTrader, and I believe this is available in MetaTrader 4 and 5. And you can see, so down at the bottom, this brownish line is the ADI indicator, and the top is the OBV I was showing. You can see they're pretty much the same. So depending on what asset you use, you can experiment to see which one's more sensitive, because you do need the sensitivity in this. Okay. The other thing is, this only works in markets that are open. At least this strategy, the way I'm going to show you, it only works in markets that trade basically 23 hours a day. Okay. So if you have a futures market like live cattle, I'm just thinking of like an agricultural commodity that only trades during the day session, it doesn't have an overnight session, then this is not going to work. Okay, so I'm looking at here, copper, oil, and natural gas, because they trade pretty much around the clock, other than obviously that 1 hour break during the changeover. So that's really important to note. Now, I don't know if this will work on other things like Forex. Again, I don't really like using these type of indicators in those markets, because, again, Forex is very decentralized, and I just don't think you're getting a reliable representation of volume. So I'm just using it on futures in markets that trade around the clock, essentially. And this is a day trading type of thing. You could probably use it on a longer time frame. But this is meant to be used anywhere from like the 5-minute to 15-minute chart. I'm going to pretty much show you the 10 and 15 minutes, maybe the 5-minute. It's pretty much the same. It gives you the same view. Obviously, the lower you go, the more detail you're getting. So here's the thing. So first of all, however you want to do it, you want to mark your chart. Down here where the indicator is from about 1,800 hours on my broker is 1,800 hours on my broker. 5.5 hours into the New York session, so that's 5.5 hours into the New York session, so that's like 2 o'clock. That's like 2 o'clock on my broker. So on my broker. Yeah, 5.5 hours, right? So 13 plus 5 is 18. So that would be 2. Yeah, basically 3. Well, let's call it 3 o'clock. So you basically want to mark from about 3 o'clock New York City time. See, we're at 4. No, sorry, it's 2 o'clock. My bad. So from about 2 o'clock New York City time until the New York Open the next morning, which is 9:30. So from about 2 o'clock my broker, 2 o'clock is 1,800 hours, and the New York Open is at 13:30. 9:30 So my broker, 2 o'clock so essentially, is 1,800 hours. So let's just show you on here. I already have this one marked out. 9:30 a.m. So essentially, let's just show you on here. I already have this one marked out. Okay, and then the New York Open, 13:30. Okay, so what I do here is, so here's the period, and this is basically represents the overnight period. You can see how dead the market is during this time, and this is natural gas, by the way. This is the May contract for natural gas. And then I just take a couple of horizontal lines. Again, you can use whatever you want. If you just want to use arrows or mark these areas. And I just basically mark the high and low zones. And this is natural gas, but I think lines work better because you want to see the whole period. I just basically mark the high and low zones of that session from about 2 o'clock, because that's basically when these markets dry up and kind of go to sleep for the night. And you can see it's pretty consistent like that every day. Not every day, but for the most part, unless there's some big news in the afternoon or something like that. Just basically mark the high and low zones of that session. But for the most part, you'll see that that time period is pretty much when these markets kind of go quiet. And you can see it's pretty consistent because most of the action is early in the morning and during the London session. Big news in the afternoon or something like that. But particularly during New York. Cause movement. Okay, and so we're just looking at this area in between these two vertical lines. So we have kind of the low over here, and the market kind of stayed kind of low here. All right, if we want to move this up a tiny bit, we can.
But particularly during New York.
Okay, and then we have this area right here.
So we're just looking at this area in between these
just
two
basically at the
lines.
open.
So
I'm going to zoom in a little bit.
Over here, and the market kind of
okay, so first of all, you can see what happens here.
All right.
So as the market approaches the open time, and I'm going to take this line off.
And then we have this area right here.
Just so
this is right, just basically
doesn't get in the way of what I'm showing you here.
I'm going to zoom in a little bit.
I'll drop a little arrow on here so you know.
So first of all, you can see what happens.
So essentially, that's the open.
So as the market approaches the open
blurb
time,
right here.
Take this line
now
off,
this is a nice little fake out and fade.
Doesn't get in the way.
So basically, what happens is you are looking for price
so
to either, as the market opens, to either approach the upper or lower boundary of the zone. So in this case, the upper boundary.
This is
and then you want to see whether you get a conclusive break with a solid break higher.
You are looking for
that can mean that the price is going to break out to the upside during that session, or whether it's going to fake out and go lower.
In this case, the upper boundary.
And in this case, what we did is we moved up, we broke out just a little bit right here. We had this little blurb right here on essentially on this candle. Right here, which threw this wick, this candle right here that threw a fake out liquidity sweep. All right, suck people into going long right here. So this candle here lines up with this little break above here, and then you can see it rejected, closed inside.
And then you can see it
okay, and then you can see the OBV started fading. Okay, and then you can see the OBV started fading. This is where you would start to look for an entry to go short. This is where you would price approached the upper boundary and failed, and then started moving lower. So right here would have been a nice confirmation area to go short, right? Because the very next candle came back with a big bearish candle, and then price just fell away. So anywhere in here, if you wanted to wait for a structure break, there's another entry right here when structure breaks below here. But anywhere in this area, this is a 10-minute chart, would be a good place to enter. And you can see this went down for the day. Okay? So you basically, this is what happens a lot. It's kind of that initial setup where the large traders will push price in one direction to go to another way. Now, it doesn't always do that. Sometimes it breaks out in that direction and keeps going, in this case up for the day. And I think one of the examples I'll show you shows that. But this is very common. And so you kind of, again, use that upper and lower boundary from the overnight session from, again, the previous afternoon, around 2, 3 o'clock in the afternoon, 1800, 1900 hours, probably not a big difference. So somewhere between 2 and 3 p.m. New York time, up until 9:30 a.m. On the New York session. You mark out those two areas and you just wait and see what happens. You might not get anything right away, but it should happen pretty quick. Okay, so in this case, we broke above and then we faded and went down. Okay, and you can see this was a super nice downtrend. This would have been a nice trade. All right, so let me jump over to, this is copper, the May chart of copper. Now you can see this one I have marked out again as well. And you can see what happened here, which is what I was just telling you. This time, we get a break out of the session. Copper out of the range, and it does not come back. It does not fade. I have marked out again, and you can see we took out structure. What I was just telling you. This time, basically right here, we get a break out of the session. So from this candle right here would have been a really nice entry right here to go short. Okay, because price broke out right at the open. Again, we can zoom in a little bit here. Basically right here. So from this candle right here would have been a really nice entry right here. Right here, okay? You can see price broke out of the range right here. Again, we can zoom in. It actually broke out on this candle right here. And you can see it did not come back. Even when it retraced, where did it retrace? It retraced back to the breakout point and went lower. So in this case, we broke out of the zone, did not fade, and just kept going down. Okay, so that is different than the first one I showed you, where it reached the upper levels of the zone, just peaked a little bit above, and then fell right back in into the zone. That's the one I just showed you right here. Okay, and then the other one here is this is crude oil, and this is much like the first one I showed you. You can see right here. Again, I'll zoom in. Right here. So here's the range I got marked out with the two vertical lines. And then you can see right here, price moved at the open. Okay. Right here. Price moved right to the bottom of the volume range from the overnight hours. Okay. So again, we had the high end of this overnight was right here. This was at like 2 or 3 o'clock the afternoon before. You can see we scraped right along here all night. Then in the morning, in the hour or two leading up to the New York Open, we saw price fade back down, or excuse me, we see the OBV fade back down, just scrape the bottom of the range right here, and then boom, New York opens and the price shoots up and goes up all day. Okay. Now you can see we had this ginormous candle right here. Hopefully you got in before that. I mean, it still would have been a profitable day, but obviously this was like half the move on this one 15-minute candle. This is why you can do this on a shorter time frame. But on this one, this candle right here, we had a bullish candle coming out of this zone, is right here. When as soon as price kind of like bounced off the bottom end of the range and started to turn back up, you could have, you know, ideally this was your entry right here. Okay, now maybe on a shorter time frame you could have gotten a little better entry. Let me jump down here. I'm going to have to readjust my line a little bit here though. So let me pull this one down because we're on a lower time frame, so the line doesn't. Yeah, and you can see right here, if we just go down to a 10-minute time frame, you can see we get the bounce right there on this little doji candle. And then we get one more 10-minute candle before the big move up. And that is definitely pointing to the upside. Right, so you can see how going down to just a little bit shorter time frame can help you with this. Okay? But again, this is just playing the fade, right? They move the price and the volume drops off as the price, as the market starts to open. It fails to break out of the zone from the range the night before and then turns back up. Now, you don't want to wait for it to break to the top side of this zone up here, because you can see if you did that, by the time that thing breaks above, you're way up here and you've pretty much missed the move. I mean, it did go a little bit further, but I mean, you left 2/3 of this move on the table. And to be honest, this is a better entry anyways because it's a lower risk entry. You could enter long, you know, right here as soon as it starts to turn. Whatever that candle is, you place your stop.
And to be honest, this is a better entry anyways because it's a lower risk.
You just leave it, and if you're wrong and it breaks lower, that's fine. You get taken out. It's only a couple of ticks. If you get in way up here, where are you going to put your stop loss? You have a much worse risk to reward trade here that you can do. Okay. And so that's the issue. So you give yourself that extra risk to reward and a much lower risk trade. Okay, so it's pretty mechanical. Like I said, and you can see on this asset on crude oil, I'm using the accumulation distribution as opposed to the OBV. Like I showed you at the very beginning, they pretty much are exactly the same. I just find on crude oil. Let me just make sure. So crude oil, I'm using the OBV. The accumulation distribution. I don't think you can see it, but this is the AD. That's the one I showed you. It's right here again under volume. It's this one as opposed to OBV. They pretty much show you the exact same thing, but I just find that on crude oil, the accumulation distribution one is a little bit more sensitive and shows the asset a little better. I don't know why that is. It's probably just the way it's traded with the amount of volume and the price action. It just is better suited for this asset. Okay? But again, it's going to show you pretty much the same thing. So again, I'm using OBV on natural gas and copper, and I'm using the AD on crude oil. But again, I'll say it for a third, fourth time, pretty much shows you the same exact picture. It's just a little bit more sensitive. Okay? Just again, make sure you use real volume and make sure there's no structure lines in there, in terms of fixed or minimums or maximums or any scaling. Turn off all the scaling, because if you don't see this detail, then you're gonna, it's just gonna look like a flat line. It's not gonna help you at all. Okay? Unless there's a really big move, and by the time that happens, you've already missed it. And again, I would recommend, you know, between a 5 and 15 minute time frame. If we go to the 5 minute on this one, I can drop this. So here's that line. You see, I got to drop it again. But here it is right here. So here's the open. And again, you get even more detail right here. You can see price comes down here. Here's the New York open. Price fades right into the line. Okay. And then as soon as it starts to turn upwards, you can get in anywhere in here. If you want to wait, for more confirmation, you can do like, you know, a trend line break, you know, across these highs here. Then you would have gotten in like, you know, maybe here, if not somewhere in here. Still a little bit of a late entry, but not too bad. You know, you would have gotten in at worst at the close of this candle. But so, you know, if you need extra confirmation, you certainly can do it. But again, low risk trade, right? Because if it looks like it's going to start turning higher, it's bouncing off the bottom end of this range from the overnight, and it's starting to turn up. You get in long right there. You just put your stops, you know, below this swing low, couple of ticks in case it wicks down on you. You don't want to be just taken out on 1 or 2 ticks, and just leave it. If you get knocked out, you get knocked out. That's whatever. That's trading. But if you're right, you get a very low risk to very good low risk, high risk to reward trade that you can ride for the day. And if we look at this thing, whoops, I'm just looking at this particular move. So where's 1800? So here's that, you know, kind of 1900 hour. I said, you know, that's the end of the session for that day. This is where you're going to start marking off. And you can see around 1800 hours, the market really starts to go to sleep in here. Now, on this day, it did wander higher all the way basically into the close. So, you know, you can use a trailing stop if you want to stay. It doesn't even have to get out at that 2 or 3 o'clock time. If you want to hold it, if the market's still drifting higher, stay in it, right? If you had your stop down here originally, you know, once it gets up into this area, you know, maybe stick your stop loss, move it way up to here, and then just keep following it up. You know, the rest of the day, if it keeps going higher, why leave it on the table? Again, if you move your stop up to say to here, you've already locked in a ton of profit. And if it does come down and take you out, then you really have locked in a decent trade. But you can see definitely after about 2 or 3 o'clock, the candles, the volume, the range gets much smaller. But again, on this day, it kept going, so you don't necessarily want to leave that on the table, right? You want to ride out and squeeze the most you can out of your winners, so maybe you hold on to this right into the close. I don't know. But at minimum, you want to target, again, that 2 or 3 o'clock time, which again becomes your starting point for the next day. Okay, which is somewhere in here. And you can see, again, the low volume of these candles. Once we get into the afternoon hours. Unless, of course, like I said, there's a news event, something happens in the afternoon that causes price to go wild. That can happen, but on a normal day, quote unquote, when there's none of that going on, then this is pretty repeatable every day. Okay? So that's the thing, guys, all right? So you want to use the OBV or the AD indicator. Okay, which are both volume and price related indicators. Okay, you want to use a market that's open around the clock essentially. You want to mark. I'm using futures again. You want to mark in the case of these 3 assets from about 2 or 3 o'clock the afternoon before up until the New York Open 9:30 a.m. You mark out on your OBV or your AD indicator. You mark out those zones. Okay. All right, and you, oh, what happened to my lines? That's weird. They like disappeared. Oh, there they are. Okay. You know, you mark out that, that night before, and then you just wait for the New York Open, and you see where it is in relation to that zone coming into the session. If it breaks out a tiny bit with, a really crappy candle, that is not sustained. Again, like we saw here with natural gas, where it just peaked out, tiny little blurb right here, but a doji candle that basically, with a big wick on top that closed. Well, not really a doji, but basically an inverted hammer that basically, you know, popped through, it came closed back in. That's very bearish, especially if it was followed up with a big bearish candle here and comes back into the range. Then you fade it short from here. Then I showed you the other one where you fade it to the, you know, where it was down, and we faded it to the upside. I think that was, no, this is the breakout one. The one that I showed you where I faded it from the bottom side was crude oil, I think. AD. I know that one we faded down too. All right, but you get the point, okay? So you just mark those out, mark out those two lines, and you just wait and see what happens when the market opens at 9:30. Are you scraping along the top or bottom of that zone you marked out, and then what happens after that? Does it break out really decisively with a strong candle above or below the zone? Or is it just, does it throw like a weak wick in there and then close right back inside the zone? And that's your key to, you know, start to fade it from the top or bottom, from the top to go down, or from the bottom of the zone to go up. And, you know, on the other hand, if you get a really strong breakout and price breaks down below that zone, like we had here on copper, where it broke out of the zone and went down for the whole day, that's fine. It never came back. We had strong close, breakout below structure on this candle right here. There's your cue to go short. Again, for these type of trades, so I guess I should say for stop loss here, because we did actually break out of the zone, then I would put my stop loss above the last swing on the indicator, wherever that lines up with price. So in that case, that would be, we had this little bump right here, okay, just before the open. I put my line on here. It's basically up here, so you basically put your stop above that recent swing, okay? And that's where you put it, okay? So we break out, you put it, you know, above that swing, and give it some breathing room, and just let it go. All right. So I like the fade ones actually really nice, because the fade ones have the lowest risk to reward, because you're basically just fading a failure to break out of the zone, up or down. And you're fading it back in the opposite direction. I actually like the fade ones, but these breakout ones are good too. Your risk to reward, your initial risk might not be as good, because your stop loss on this one's going to be way up here, but it's still fine. In this case, it would have been more than fine on the way down here. This is a big trade. Okay, and then just remember, you know, you should target your exit to be somewhere around 2 or 3 p.m. New York City time, when all these things kind of start going to sleep. But if the market's still moving in your direction at that time, you don't have to close it then. Just adjust your stop loss, use a trailing stop, move your stop up to that area at 2 or 3 o'clock, move it up to that zone up there, and then just leave it. Let it run right into the close or whatever you want to do. And if it does start to go against you, at least you've locked in the majority of your profit. And if it does go against you, you know, late in the day, fine, you get knocked out, and you know, you still make a good profit on the day. Okay? So you may not get these setups every day, and there's going to be some days, guys. I just showed you 3 where they worked out really well because they trended. You're going to get some days where you play the fade and the market goes nowhere. It's just a sideways day where the market just whipsaws back and forth inside that zone and you go nowhere, okay? Or it does break out, and then an hour later it turns and goes clear back the other way and slashes right back through the zone, and you get knocked out there, okay? But more commonly what happens is, if you read it right, more commonly, if you're going to have a loser on these, it's because the market's just range trading, and you're not going to know that right away. It's going to take a couple hours. It's going to, well, maybe not even a couple hours. It's going to probably take maybe an hour or so for you to know that, hey, this isn't going anywhere for the day. Price starts to fade it, or you play the breakout, and then the price just does nothing. It just keeps whipsawing, bouncing inside that range, in and out of that range that you drew. That's going to happen, and that's probably going to happen at least one day a week on any one of these assets, because you're just going to have slow days like that. So that's fine, but you know, I got 3 of them up here that I'm doing this with. So one of those 3 probably will hit. The chance of all 3 of them ranging for the day, unless you know the whole market's waiting for some news. One of them will probably move, you know, even if the other two are range for the day. But hey, if they're all ranging, then fine. Then you know, either you don't trade that day, or you take a loss and just stand aside. And that's the other thing. Don't get greedy and try to take trades on all three of them, because if it ends up being one of those ranging days and you take a trade on all three of them, you could potentially end up with 3 losses. Okay, so you know, I would say at least for if you're just experimenting and trying this, you know, take if they're all showing setups, then take one that you know, take one that looks the best and has the best risk to reward ratio, and just go with that. All right, just be careful. You know, like anything else, practice good risk management. Don't over leverage it, and you know, don't get greedy. But also let your winners run too if they're there. I mean, don't be so quick to exit at 2 o'clock in the afternoon or 3 o'clock in the afternoon just because it's 2 or 3 o'clock. Move your stop loss up, you know, a trailing stop underneath or just above or below the price, depending what direction you're going in, and let it run. And you know, if you get taken out at that point, so be it. You still have a good profit. All right. So I'm going to leave it there, guys. I hope that was helpful. Simple, pretty straightforward mechanical day trading strategy using OBV or accumulation distribution volume indicators. Again, both indicators take price and volume into account. And again, make sure you use these on centrally traded assets like futures and on assets that trade essentially around the clock, because you need that quiet overnight kind of baseline established zone to help you decide the next day during the New York session, when the volume is the highest, which direction you want to trade in. If it's an asset that closes in the afternoon, like you know, cattle that closes at 1 or 2 o'clock and doesn't open until 9:30 the next morning, there's no overnight, so that's not going to help you. Okay. These are 3 examples of assets that do. You probably could use it on any of the indices like S&P, NASDAQ, Dow, whatever. Probably because those trade overnight. Personally, I don't really like those very much, so I just tend to stick with these energy and metals ones. I haven't tried it on anything like gold, but I'm happy I got these 3, and that's more than enough for me. Okay? So let me know what you think. Questions, comments, leave it down below. I hope that was helpful, and I will talk to everybody soon. And you know, if I have any more good insights or any good trades on this, I'll let you know. But again, smash the video on your way, the like on your way out. Subscribe to the channel, and I'll talk to you soon. All right, thanks.